Hello, everyone. Welcome to another presentation on investment and portfolio management. So for today, I'll be discussing about the different types of bank accounts and credit securities. What is a bank account? It is a financial account maintained by a bank in which the financial transaction, such as deposits, withdrawals, loans, between the bank and the customer are recorded. Terms and conditions apply for each type of bank account, such as deposit accounts, current accounts or checking accounts, credit card accounts, loan accounts, or many other type of accounts. So in choosing a bank or when opening a savings account or a time deposit in a bank, it's very important to consider the following. What is the minimum balance required? Some banks require a minimum balance of 5,000 pesos. Other banks are requiring 10,000 pesos. Why is it important to know the minimum balance required? Because some banks are imposing penalty once you go below the minimum balance requirement. It is also important that you look at the interest rate. How much are you earning from your savings account? Some banks give 0.25% per annum. Okay, other banks give 0.20% per annum. Another factor to consider is the withdrawable limit. For over-the-counter transactions, generally there is no limit as to the amount that you can withdraw. But for ATM transactions, you have to inquire with the bank how much would be the withdrawable limit. There are banks with a withdrawable limit of 50,000 per day, and there are banks that limit you to withdraw up to 10,000 pesos per transaction. Okay, now it's also important that you look into the bank's reputation, the track record of the bank. So you look into the integrity of the bank because you let the bank safekeep your money. So this is hard-earned money that we're talking about. So it's very important that the bank is worthy of your trust. And of course, last but not the least, insurance. So PDIC maximum insurance is 500,000 pesos per account. Now, there are different type of bank accounts that you can choose from. One is current account. Current account is also known as a checking account or a demand account or transactional account. So this is a type of bank account from which withdrawals are made by issuing checks. So this is an example of a check. This is a BPI check. Okay, so you can see here the date, the amount in words, of course, in figures. And of course, you may customize your check with your name on it. And of course, for control purposes, it's very important that there is what we call an account number and check number. So this is an example of an individual checking account. There is only one signatory. However, for corporate accounts or institutional account holders, there are two signatories. Checking accounts are considered very liquid. It's, of course, you can encash it anytime for as long as there is fund in the bank. It allows for numerous deposits and withdrawals as opposed to less liquid savings or investment accounts. But you have to remember that a current account or checking account does not earn interest compared to a savings account. Okay? Some banks require a minimum savings account before it issues checking account. So the good thing about having a checking account is it's more convenient because instead of bringing cash, which is susceptible to loss and fraud, with a checking account, you simply issue check and pay your employee or supplier. So it's very convenient to issue checks instead of cash. Now, another type of bank account is, of course, a savings account. So this is one of the popular types of bank accounts wherein deposits thereto and withdrawals therefrom can be made anytime. So deposits and withdrawals are made with the use of deposit slips and withdrawal slips respectively. So you see on the screen an example of a deposit slip of Metro Bank and the withdrawal slip of BDO. So every time you deposit an amount in the bank, so you fill out a deposit slip. And every time you withdraw, you also fill out a withdrawal slip. So in a deposit slip and withdrawal slip, you have to indicate, of course, your name, your account number, and of course, the denomination, the date, and your signature. Okay. Now, for time deposits, it is a loan to a bank for a fixed term. You're actually lending money to the bank, and these are evidenced by certificate of time deposits or CTDs. So there is no penalty imposed in case you as a depositor decides to pre-terminate your time deposit. So let's take, for example, Security Bank Peso Time Deposit for 100,000 to 299,999. If you look at the 12-month interest rate, that's 1.0100%. So even though the contract says it's for 12 months, you can actually pre-terminate your peso time deposit without any pre-termination fee. Okay, next, special time deposits. This is a type of bank account that earns interest higher than ordinary time deposit. That's why it's called special. So these accounts are withdrawable anytime without penalty, just like a regular time deposit, but of course subject to adjustment for the corresponding interest. So interest earned on a special time deposit is normally computed monthly, and the accounts are renewable every month at the shortest. So an example of which is a Development Bank of the Philippines special time deposit. The minimum placement is 10,000 pesos, and the term is for 30 to 365 days. So you are issued a passbook, and the interest rate is of course quoted by Treasury. Now, trust investments is also known as common trust fund. It refers to a trustee bank for investment in chosen items such as treasury bills, loans, stocks, and bonds for the benefit of the designated beneficiary. In a trust investment, you call the investor a trustor or grantor. Trust investment is not part of the normal bank operations so that it is not insured with the PDIC. So a very good example of a trust investment is Unit Investment Trust Funds or UITF. So it works similar with the mutual fund in a sense that your money is invested in different type of securities in the market, such as in stocks, in bonds, in commercial papers, and in savings account. So the return of your money depends on the performance of the stocks or bonds in the market. UITF, since it is a product of the bank, it is subject to a capital gains tax of 20%. UITF, since it is a product of the bank, it is regulated by the Bangko Sentral ng Pilipinas. In a unit investment trust fund, what you own here is unit of participation. Okay? Unlike in stocks, you own shares of stocks. In a UITF, you own unit of participation. There are banks in the Philippines that offer a minimum trust investment amount of 10,000 pesos, and there are banks that offer a minimum initial investment of 100,000 pesos. So I'm done discussing some of the popular type of bank accounts. Now this time around, let's define what securities are. Securities are written evidences of ownership, interest, or participation in an enterprise, or written evidences of indebtedness of a person or enterprise. Securities are fungible or tangible and tradable financial instruments used to raise capital in public and private markets. So when we talk about securities, we are referring to ownership. When you buy shares of stocks, you actually own shares of stocks of publicly listed companies. Interest, you earn interest income from the amount that you invest in bonds or credit securities. And of course, participation, for example, in a unit investment trust fund, or written evidences of indebtedness, such as credit securities, or when you lend money to the government through treasury bond or treasury bill, or to a corporation through commercial paper or corporate bonds. So there are three types of securities. We have equity, debt, and hybrids. So equity provides ownership rights to holders, such as common stocks. Debt, essentially loans repaid with periodic payments, example of which are treasury bills and treasury bonds, and hybrids, which combine aspects of debt and equity. Preferred stock is a good example of a hybrid type of security wherein it is considered an equity because you own shares of stocks. However, it resembles that of a debt because preferred stocks receive fixed dividends. All right, so you can see on the screen examples of securities in the market. So as to ownership, you have stock certificate. Okay, and as to participation, you have unit investment trust funds, interest from corporate bonds, treasury bills, commercial papers. Ayan, so these are credit securities. Now, let's classify securities. First and foremost, based on their maturity. All right, so here you can see the financial market is composed of money market and capital market. So money market refers to trading of short-term securities. They are considered as near cash securities on the part of the investors and those maturing within 3 months as cash equivalents. Example of money market instruments or securities are the following: commercial papers, treasury bills, and certificate of deposit. So commercial papers are issued by corporations or commercial companies, whereas treasury bills are issued by the government and certificate of deposits are issued by banks. Okay, now capital market refers to trading of long-term securities. Some of the common capital market securities are stocks, bonds, and derivatives. Now, based on who is the seller, okay, we can classify securities as to primary or secondary market. So both primary and secondary market are part of the capital market. So when we say primary market, here the seller is the issuing entity. The proceeds from sale of securities go to the issuing corporation. Example is during an IPO or initial public offering, or the first time that a company issues its shares of stocks to the public. The proceeds from the sale of securities will definitely go to the issuing corporation. For example, Pure Gold issues shares of stocks through an IPO or initial public offering. So that means that the proceeds from the sale of the securities will go directly to Pure Gold. Okay, that's the primary market. Whereas in a secondary market, here the seller is a party other than the issuing entity. The proceeds from sale of securities do not go to the issuing corporation. So a very good example of a secondary market is the Philippine Stock Exchange. All right, it is called secondary because when you buy shares of stocks, you are no longer buying from the original issuing corporation. Remember that after an IPO, the shares of stocks of Pure Gold had already been bought by other buyers. So when you now buy shares of stocks through the Philippine Stock Exchange, you are no longer buying directly from Pure Gold, but the secondary owner of the shares of stocks. Now, let's proceed to credit securities. Credit securities are evidences of indebtedness issued by an entity as a vehicle in borrowing from the public. So example of credit securities are the following: commercial papers, corporate bonds, treasury bills, treasury notes, treasury bonds, collateralized debt obligation or CDOs, and mortgage-backed securities. Before you invest in credit securities, you have to be aware of the following factors: interest rate, maturity date or call date, the value of the security, yield on the maturity, credit rating of the issuing party, credit rating of the trustee, if any, and credit rating of the underwriter, if any. So what are the different type of credit securities? So let's start first with commercial paper. When we say commercial paper, this is a money market security issued or sold by large corporations of unquestionable credit standing and reputation to meet short-term obligations or working capital requirements. So take note that commercial papers can only be issued by corporation of good reputation or are credit-worthy. So the Securities and Exchange Commission has a list of corporations who are allowed to issue commercial paper or to borrow money from the public. Commercial papers are short-term credit instruments, and it is not backed by collateral, but only by an issuing bank or company that promised to pay the face amount on the maturity date. To the issuer or to the corporation that borrows money, one of the advantages is that they pay a lower interest rate. Also gives them access to short-term funding. So it's one way for them to raise capital. It gives them more flexibility and liquidity. So just in case they need money, just by issuing commercial papers, they can actually raise more capital. Investor recognition, there is ease and low cost of establishment, and there is no collateral involved. On the part of the investor, a commercial paper normally provides a higher yield compared to savings account or time deposit. It is also a good way to diversify your investment portfolio. So instead of just putting all your money in stocks or in real estate, one of your options can be to invest in commercial paper. It also gives investors more flexibility and liquidity, especially in terms of receiving interest income from the lending of the money. All right, now what about bond? So it has a fixed interest rate because here the bond issuer, for instance, the government or companies, offer their creditors or lenders a fixed interest rate and has maturity date. Okay, in comparison to common stocks, bondholders or the lenders of the money are not entitled to any of the rights and privileges associated with common stocks, such as the right to vote at stockholders' meeting. Remember, if you are a bondholder, you are simply lending money to the government or to commercial companies. Okay, the principle of bond, also known as an issuer's par value, specifies the amount of capital that must be repaid at a maturity. The maturity date on a bond is fixed. A bond's coupon is the annual interest income that the issuer will pay the bondholders. This is also known as the interest rate. Now, let's see how bonds work. Okay, as a bondholder or investor, meaning to say you are the one lending money, you lend money to the government or to commercial companies. Okay, so the government or the companies that borrow money are called bond issuers. So they will issue bonds or certificate of indebtedness to you. All right, so in return, the government or companies will pay you an interest income. Okay, so the interest rate is fixed, and of course, there is a maturity period. So normally, bonds mature in 15 years, 20 years, 25, or even in 35 years. Okay, how does a bondholder earns from his bonds? All right, so bond income is in the form of current income or capital gain. Okay, current income, it comes from periodic interest payments paid over the life of the issue. So it's the interest income or the income from the coupon or interest that you earn from the bonds. Now, capital gain is actually the gain from the sale of the bond. So for example, if the bond will mature in 30 years time and then you have decided to sell that prior the maturity when the market price is greater than the bond's interest rate, therefore you gain from the sale of that bond. Now, let's classify bonds. All right. So, as to the issuing party, bonds are classified as government bonds or commercial bonds. So, it would depend who issues bonds. If it's the government, okay, that issues bonds, we call that government bonds, example of which are treasury bonds. If it's issued by a private corporation, it's a commercial bond or corporate bond. Now, as to security, okay, bonds are classified as mortgage bonds, equipment trust bonds, collateral bonds, and debenture bonds. When we say mortgage bonds, the bonds are secured by lien on real property, meaning there is a collateral, and the collateral are real properties or title of real estate. Equipment trust bonds, these are bonds secured by equipment of the company. So the collateral here is an equipment or equipments. Collateral bonds are secured by securities invested in by the issuing company. And when we say debenture bonds, these are bonds that are unsecured, meaning to say there is no collateral. As to maturity of principal, we classify them as straight bonds, serial bonds, convertible bonds, callable or redeemable bonds, and non-callable or non-redeemable bonds. So when we say straight bonds, this is a type of bond wherein the entire principal will mature in one time. Okay? When we say serial bonds, the principal matures in installments. For example, instead of a one-time payment, okay, the government will pay you annually. So we're talking about series of payments. Okay, convertible bonds, these are bonds that can be converted into common stock at the option of the bond holder. So meaning to say, if you own bonds and it is convertible type of bond, there is an option for you to convert your bonds into shares of stocks. Callable or redeemable bonds, they can be called, redeemed, or retired by the issuing company before maturity date. And non-callable or non-redeemable bonds, this is a type of bond that is not subject to any call. It cannot be redeemed or retired prior the maturity date. Okay, can bonds be transferred to another party? All right, so as a transferability, there is what we call bearer bonds. So they can be transferred to other parties by mere delivery. Okay, so whoever holds the bonds are considered owner of the bond. So they are not registered in the books of the issuing entity. Coupon bonds, these are bonds in which interests are paid to the holder of interest coupons. And registered bonds, as the name suggests, they are registered in the books of the issuing entity. So they are registered bonds. Now, what are treasury bills? This is another type of credit securities. So treasury bills are government securities that mature in less than a year. Okay, less than 365 days. So treasury bills have three terms. It can be a 91-day treasury bill or 182 or 364-day treasury bill. They are considered among the safest investments since they are backed by the full faith and credit of the government. We have not heard of any government in the world that went bankrupt, right? So the government can always pay you back. When an investor buys a treasury bill, they are lending money to the government. So it's always safe to lend money to the government. So this is particularly appropriate for investors who will be needing their money in a short period of time, say in less than a year. So if treasury bills are short-term, treasury bonds are long-term credit securities. They are fixed government debt securities with a maturity range between 10 and 30 years. T-bonds normally pay semi-annual interest until maturity, at which point the face value of the bond is paid to the owner. Along with treasury bills, treasury notes, and treasury inflation-protected securities, treasury bonds are one of the four virtually risk-free government-issued securities. Again, because the payment of the principal and interest are fully guaranteed by the government. So let us differentiate treasury bills from treasury bonds. So in treasury bills, the interest here is fixed, whereas in treasury bonds, interest is not fixed. All right, so treasury bills here, interest is paid upfront, whereas in treasury bonds, interest is paid biannually or quarterly. So in treasury bills, it's paid one time because it's a short-term type of investment. All right, so treasury bills, they are short-term type of credit securities, whereas treasury bonds, they are long-term type of investments. Treasury bills are backed by the government and are fully guaranteed by the government, so as treasury bonds. All right, now there are 5 major types of risks that bonds are exposed to. When you invest in bonds, you have to expect that there are risks involved, one of which is interest rate risk. When market interest rates rise, expect bond prices will fall and vice versa. There is an inverse relationship between interest rate and that of bond prices. Again, when the interest rates rise, the bond prices fall. And when the interest rates fall, bond prices rise. Okay? Now, there is also what we call as purchasing power risk. This is the effect of inflation or the increase in the general level of prices, which leads to decrease the purchasing power of our money. The risk here is when the return of bond does not beat inflation rate. For example, you lend your money to the government earning 5% and the inflation rate is 6%. Therefore, the interest of your bonds does not beat inflation rate. So you're not actually earning. So it would be better if the interest of your bonds is greater than that of the inflation rate. Now, there is also what we call business or financial risk, particularly when you are lending money to corporations. Once the corporation default on paying interest and principal, that's the risk. All right. Next, liquidity risk. This is the risk that the bond will be difficult to sell at a reasonable price if the investor wants to sell it, particularly selling it prior the maturity date. Now, call risk. So this is the risk that the bonds will be called or retired long before its scheduled maturity date. So for example, if the bonds will mature in 10 years time, but the bond issuer called or retired that bonds before the 10th year maturity date. If you are a prospective investor, your question would be, am I going to lend money to this particular company or to the government? So to relieve you with the stress of evaluating or thinking if it's worth investing your money in this company or in the government, then bond ratings can help you make a decision. So there are three famous international credit rating agencies that publish their credit ratings on bonds. So we have Moody's, Standard and Poor's, and Fitch. So this is their ratings classification. We have AAA, AA, triple B, double B, B, triple C, double C, C, and D. And of course, the highest rating would be AAA. It is defined as a high-grade investment bond. So meaning to say, when a company or the government is rated as AAA, it denotes that the company or the government has extremely strong capacity to pay principal and interest. Okay, now if the ratings fall under triple C or double C or D, okay, it is more risky on the part of the creditor because it means this company or the government can default in paying its principal and interest. So the risk is very high. Okay. Now, when you invest in bonds, how do you make sure that you minimize the risk of losing your money? So there are actually different strategies that you can apply or implement. So one of which is a buy and hold strategy. Here, investors replace bonds that have deteriorating credit ratings, have matured, or have been called. This is a passive bond management strategy. You simply purchase individual bonds and hold them for the longest time or until their maturity period. Your main concern here is to receive cash flows or interest income that can be used to fund your basic needs, living expenses, or some of your financial goals. Or you can actually reinvest that in the portfolio into other bonds or securities. Now, bond ladder is another passive approach to bond investing. Bond ladder is a portfolio of individual bonds that mature on different dates. In this strategy, equal amounts are invested in a series of bonds with staggered maturity. So for example, if you're planning to invest in a 10-year bonds instead of investing in a one-time 10-year bond, you will divide that amount into equal parts. So say 1 million pesos divided by 10 years. So you will have a principal of 100,000 pesos every year. So if that principal is earning 5% coupon or interest rate, that gives you a 5,000 interest income every year. Now, as for active investment approach, we have forecasted interest rate approach. This is when investors seek attractive capital gains when interest rates are expected to decline, and preservation of capital when an increase in interest rates is anticipated. It is a more active approach because it's like betting on the future rather than settling on the current times with lower returns. You're actually taking advantage of expected changes in the interest rates, in bond yields and credit ratings. So basically, when you see that interest rates are falling, your strategy would be to hold long-term bonds. But if interest rates were expected to rise, then you would rather buy bonds with shorter durations. And last but not the least, we have bond swap strategy. Now, bond swap occurs when the proceeds from the sale of one debt instrument are used to subsequently purchase another debt instrument. So once your bonds mature, you will replace that by another bond security for you to be able to maximize your return or maintain the value of your portfolio. Buy and hold strategy and bond ladder are both forms of passive strategies, whereas forecasted interest rate and bond swap are active strategies. As for my last slide, let me wrap it up. So I have already discussed the different type of bank accounts, such as current account or checking account, savings account, time deposit, and trust fund. And I have also given you an overview of what commercial papers, treasury bills, and treasury bonds are. All right, so that's it. Thank you so much, guys. If you have learned something from this presentation, kindly subscribe and give this video a thumbs up. Thank you, everyone. God bless.